The Coalition Greenwich FX discussion. On the call, you have Tom Jakes and Subodh Karnik. We are both members of the research team at Coalition Greenwich.
Thank you, Tom.
We wanted to record this podcast today to discuss various issues in the institutional FX market. Coming out of the COVID crisis, there's been a lot going on, a lot of change. We want to just touch on these issues. So to start with, we'd like to talk about liquidity in this post-COVID world. What does that mean? How has it changed?
Thanks, Tom. This is, this is interesting stuff. And this is, again, I just want to make sure people know that this is based on multiple discussions you, myself, and other members of the research team have had with various participants in the FX markets, both on the sell side, the buy side, venues, and what have you. Liquidity is an interesting idea and an interesting concept. And through COVID, people realized that not all liquidity is created the same, not all venues are the same, not all sell side providers are the same. And what I think the buy side quickly has now come to terms with the fact is that it's not just the superficial liquidity you see, but the depth and the quality are equally important. And by that, I mean, when you scrape the top, how much is the replenishment available? When you do scrape the top, do you actually get filled? Everything from last look to the quality of the replenishment is in play. And people have become more intelligent about assessing the quality of their fills, being a lot more disciplined about understanding that when an order is executed, post-execution, in fact, even during execution, but definitely post-execution, assessing the quality of how the fill was executed and the footprint left behind. For the first time, I come from the sell side, and these are discussions we've had on the sell side for a while, but I'm now hearing more and more from the buy side terms like markouts and footprints in the market, and an understanding of what their impact is, their own flows, as well as the way their counterparts are hedging those flows. So there is a lot more thoughtfulness going on.
I think it's certainly been an access to data and the ability to analyze it that has really helped both the buy and the sell side in this market.
Absolutely. And there are third-party providers who are quite smart about this, but a lot of the buy side has now started, at least the larger ones are starting to build their analytics and data analysis teams in-house. And this is not just FX. FX just happens to be typically at the forefront of electronification, and therefore there's a ton of data available. But this is across the fixed income markets that there is a fair bit of thought being put to assessing the quality of execution, assessing your own impact, and assessing the impact your sell-side counterparties are having when they hedge your flows. And I think it's for the good. I think it will improve the experience and improve the monetization, improve the experience as well as improve the execution quality that the buy side will obtain.
Definitely. And as clients are thinking more and more about how they're executing, are they thinking about different ways of executing in this market? In particular, one thing that's come up in a lot of the conversations we've had is, do I execute via an algo or do I execute via risk transfer? How are people thinking about that in the post-COVID world?
That's an interesting question. And, there used to be, and there obviously still is a debate around risk transfer versus algos. For the buy side looks at foreign exchange many times, and there is obviously a large contingent that still, uses foreign exchange for alpha. But if you look at the typical real money buy side participant, foreign exchange is something you do to hedge yourself out of exposures that it's a service they expect the buy sell side to provide. And when you're talking of risk transfer, essentially you cross a spread and then the sell side or the liquidity provider manages the risk. In an algo, effectively the buy side retains the risk and they pay a fee for hopefully an efficient and smooth execution into the market. Now, what has happened through COVID is that the buy side has realized, and we're hearing it from a lot of the larger players, is that the latest suite of algos available from some of the top players are actually extremely sophisticated and quite adaptive. So they are able to adapt themselves as liquidity conditions change in the market. And therefore, even though the buy side retains the risk in theory, while they execute through algos, they're realizing that the algo they're using is quite smart in terms of how it flexes and changes as the market conditions change. And so two things that are happening because of that. As the confidence in these algos has gone up, we are seeing algo usage coming down the notional curve, which is people are using algos even for smaller tickets. Originally, it used to be for the medium-sized tickets, and the small tickets, oh, it doesn't matter. I'll just cross a spread on the electronic and on the machine. And now people are trusting algos to even handle lower-sized tickets. And the other thing is, originally the thinking was, I'll use an algo and passive algo when markets are quiet. In volatile markets, I prefer risk transfer is too dangerous. But seeing some of these adaptive algos, I think there is an increasing trust in using them even during volatile times. Now, of course, in a dislocated market, you'll still have to rely on picking up the phone and crossing a spread and relying on your top providers. But for the most part, in a noisy market, equities are coming off, bonds are selling off, and FX is jumping around. People are still sticking to algos and finding that they're performing extremely well. And so I think we are coming to a stage where that particular way of modality of executing will see continued growth.
Yes, certainly. I think algos are great for the buy side. But also, one thing I've heard is they're good for the sell side too, simply because they're operating in really tough market conditions at the moment. Spreads have come in an awful lot, and that's made it a real challenge to operate in this market. What have you heard about that, Subodh?
Absolutely, and we wrote a paper about this at the beginning of the year related to this, which is the monetization in electronic FX, and it's very difficult. Multi-dealer platforms are practically impossible to monetize given the modality of how they operate, and I would recommend people read our paper. But even otherwise, in bilateral connectivity, you have effectively on the single dealer platforms, a set of incumbent players, the top 4 or 5, I would say, who are very difficult to dislodge. So if you're not part of that group of sell side players, it's very hard to participate from the sell side through the SDP channel. Algos, API connectivity is great, but again, that involves getting initial investments done on building the API connectivity, making sure your client is on board with connecting through the API. Algos are great because one, they can port through portals like Bloomberg and many others, FXall, and number two, effectively it's a risk-free principle business where you are essentially doing a fee activity. Most sell-side banks that offer algos effectively have that algo execute directly on various platforms and venues. And on paper, you can think of it like agency execution. So it is a fee business, and therefore the risk is limited.
It's also, I think, one of the ways, sorry to interrupt, but one of the ways in which the sell-side institution can demonstrate its intellectual capabilities as well.
Absolutely. And most sell-side algos worth their salt now offer a excellent quality TCA. They offer a lot of modeling and pre-execution liquidity analysis and advisory. So it's a fairly sophisticated field with some of the top players having invested a fair bit of time and effort in building some extremely sophisticated products. So I think this, as the buy side gets more comfortable with this modality of execution, I see a fair bit of growth here, and I think some of the MDP execution probably will bleed over here, especially where there is no real statutory obligation or a documentary obligation to compete the business in a multi-dealer fashion.
Yeah, interesting. We've talked a lot today about electronic execution. This clearly has great economies of scale, but it costs a lot to do. What do the banks who are outside the top 10, top 15 or so do? How do they continue to compete?
That's a very good point. I mean, this is not cheap. And if you look at the top 3 players, they invest enormous amounts to stay ahead. And therefore, if you are not a top tier player, if a second or a third tier player, it's not enough to build an electronic suite. There is enormous amounts of investment to be done just to stay current. So at some stage, you have to confront, if you're a second or third tier player from the liquidity provider side, you have to confront the question of, buy, build, buy, or rent. And there are some interesting models being tried out. I mean, I'll give you one example. I won't name the players, but there is a regional that is a very high credit quality bank. That's a second tier bank in the FX markets, and they realized they're very smart, and they said, look, we don't want to compete on building the electronic machine. They don't want to compete on price per se, but what we can compete on is providing ourselves an excellent counterparty. And so they have now tied up with a very large non-bank liquidity provider who has some of the best algos in the market. And effectively, not even white labeling, they're putting this non-bank liquidity provider's algo on their screen for their clients in the non-bank liquidity provider's name. And when the client trades on this, they get fantastic execution through a great algo, and they get the bank as the counterparty. So from a buy-side user's perspective, it's the best of both worlds. You get to deal with your credit counterparty who you like and are comfortable with and have good docs with, have good terms with. On the other hand, you don't have to worry about them not being competitive in the FX markets because you're getting to access the algos and the liquidity that this non-bank liquidity provider provides, which is best in class, absolutely, on a global basis in G10 FX. But they don't have great docs and they don't have any credit, and you don't want to really get into the discussion on getting docs with them. And that's the kind of model that's going to come up for the second and third tier banks, where you don't have to do everything. Let that be the worry for the top players.
Yeah, I certainly think it's going to be a world where everyone has to ask, what do I do? What's my advantage? And what can I bring in from peers to leverage what they have? So we've talked a lot about electronic trading here. But that's not the full story. We still see a lot of voice trading going on. How's that interaction going to evolve over the next few years? Are we going to see increasing amounts of electronic trading? Is voice execution going to end? What do you think?
So I joined the FX markets 1995, 1996. That tells you how old I am. And I've been hearing about the death of FX and the death of voice FX for a while. And here we are, 2021 going into 2022, and people are still doing it. But you're right, I'm being facetious. Electronification will continue. The last bastions were, say, forwards and swaps, and we've seen in the last 12 months or since COVID some very interesting moves done by certain venues to create essentially what could be called a club with a decentralized credit model, and that lets buy side interests match each other off over a time window. Options is still left where there is an element of advisory and there's an element of lumpiness that is very hard to electronify. So what you'll see is voice desks shrinking to accommodate where genuinely there is value to be added from either a content or a ticket size perspective or a uniqueness of underlying product perspective. Everything else goes electronic. Now, electronic coverage itself is evolving. When I started, when I saw these markets start up getting electronic, a lot of the coverage was about connectivity, about getting people on your single dealer platform and those kind of things. Now, your electronic salesperson is really your electronic advisory person. They're talking about how best to tweak liquidity, how best to access, what's the liquidity profile of the market, what footprint you left when you dealt when they talk to their buy side clients, how best to minimize that footprint if that's what your aim is, which it should be. So it's become quite a sophisticated advisory job. Of course, there is still the nuts and bolts of connectivity and making sure your streams are going right and all that good stuff. But a lot of time now at the top banks by electronic salespeople is spent essentially doing liquidity advisory, which I think is the right way to go, given how sophisticated the product is.
Yes, certainly. That's something that I hear. That sales has become a lot more sophisticated as a particular role that people have to do. They have to think about a lot more things and know a lot more about the technical aspects of the market. So we've talked a lot about FX today. The one elephant in the room is cryptocurrency. Yes. Now, there's obviously a debate as to whether it's a currency, whether it's a commodity. Some people will say it's the tool for Web 3.0. But what I do see is a lot of volatility, a lot of trading, a lot of interest. What do you see going on in the space, Subodh?
That's interesting. So again, we wrote a paper recently on this topic, and I urge people to access that. It's available through our website. But look, I mean, crypto is an interesting idea. It's obviously, it's the rage, as they say. As things stand, banks are going to find it quite hard to make markets on the physical side. The regulatory environment is just too uncertain, and internal approvals will be difficult to get, from a product and compliance and legal and onboarding and engagement perspective for buy side. Having said that, we talk to these guys every day, and they are some of the smarter people on the planet, and they've figured out ways around it. And one way is to create derivatives on the crypto markets. And so, between ETFs, futures, and now NDFs, there will be modalities for the buy side to access the crypto markets through derivatives. I have a feeling that NDFs will take off quite a bit because, again, it's an OTC product. It's very flexible, it's customizable, and both the buy side and the sell side are extremely comfortable with it, not just from a market making and trading perspective, but the internal risk control guys and the compliance guys, they understand how it works. It's a very robust and well-tested product. So I think that's kind of the future, and there is interest in it, obviously, because as spreads have compressed on the traditional FX side. This is still new. There is high volatility. There's potential for alpha, and there is still quite a bit of things that can happen in this market that are idiosyncratically different from the correlated financial markets that sometimes people get frustrated with. So should we say that's the future?
Who knows? Who knows? It's certainly very exciting at the moment. So I think people are making big bets and enjoying riding the volatility. On that note, I'd like to thank you very much for your time today, Subodh. It was a really great conversation.
Thank you, Tom. This was delightful.
Okay. And thank you all for listening to the end.
Thank you.